Hi, my name is Tom Love, and I want to talk to you about something that I've been doing for my clients probably for the last 35, 40 years. And I discuss 3 buckets of money, where we talk about where we put our money, whether it's pre-tax or after-tax, will determine how many more checks we write to the United States Treasury. It's the type of investment that will dictate the amount of tax that we owe. Let me give you an example. I'm going to show you 3 buckets, and let's assume each bucket has $1 million in it. Now, the first bucket I'm going to call a qualified retirement plan, where I have been able to contribute on a tax-deductible basis, and I've struck it very well, and I've got a $1 million balance. Now, let's assume the second bucket is non-qualified money. It's a brokerage account where after tax, the money that I have left over after I've been taxed is going to be invested. Could be in the same investment that the IRA is in or the qualified retirement plan is in, but I choose to invest after tax. Now, I have $1 million in that account as well. And let's assume over my lifetime I've put in roughly half, and the account has basically doubled. And I've been paying taxes on the distributions as they were being taxed to me, so my cost basis is half. And the third bucket is something we call cash value life insurance. Let's assume I have $1 million in cash value. What I would like to do is I'd like to show you how wealth is spent, not accumulated, how wealth is spent. And let's assume that I were to call each of my brokers, the broker that has the qualified retirement plan, the broker that has my brokerage account, and my broker who owns or helps me with my life insurance policy. And I ask the broker to send me an 8% distribution. Now, I'm not earning 8% necessarily anywhere. I just want $80,000. Now, in the IRA, it's all taxable. In the in the center bucket, the brokerage account, again, half of that money is my own. There's 3 ways I can compute the taxes due that are on that distribution. I choose the actual price per share method. And here I've pegged the value of the distribution at $40,000 return of principal, $40,000 subject to, if held for 13 months, long-term capital gains. Now, you won't hear this very often, but is there a favorable tax in the tax code? Yes, there is. The long-term capital gain. Taking $80,000 out of the qualified money, I could pay as much as $28,000 plus in taxes. I take $80,000 out of the brokerage account, I pay as much as $8,000 in taxes if I've held the money for at least 13 months and my cost basis is roughly half. And in the far right bucket, the cash value life insurance, I don't even have to declare that as income. It's classified as a loan. See, we talk about how to use cash value as collateral and spend somebody else's money, the insurance company's money, and I keep the cash value inside the contract. We use a whole life type of product so the cash value is guaranteed to grow, even though it's been collateralized and used to spend money from the insurance company. My account is guaranteed to be worth more. We've got a little over $3 billion of clients' money that isn't subject to the stock market influence, isn't subject to political influence, guaranteed to be worth more every single day, and none of it is going to show up on a federal income tax return. Would you like to see how you could add your money to that block of cash and also accumulate as much wealth as you want and minimize the income tax burden that is due? There are ways to do it. It's in the tax code. There are 6 places that use the word exempt where distributions cannot be put on a tax return. You want to know what those are? Check us out.